All right, stop scrolling for a second because something just snapped in the silver market. In the last session alone, silver ripped more than 12%, screaming back toward $90 an ounce, after collapsing from near 120 to 78 in what felt like minutes. That's not a typo. We're talking tens of billions in paper value vanishing, then reappearing almost instantly. And here's the part you need to hear right now. Both US policymakers and global institutions just confirmed silver is being treated as a strategic resource, not a trade anymore. Stay with me, because I'm going to show you what actually caused this violent move, how to recognize it the next time it happens, and why this moment matters way more than most people realize. If you're watching this now, you're ahead of 99% of people who'll only hear about this weeks from now when it's already priced in. Before I explain what triggered this whiplash, let me slow it down and teach you something most people never learn about markets. Price doesn't always move because the story changed. Sometimes price moves because the plumbing breaks. And if you don't understand that difference, you're going to make terrible decisions at the worst possible times. Think of markets like a crowded theater. Nothing's wrong with the building. The movie's still playing. But someone trips near the exit and suddenly everyone's pushing, not because there's a fire, but because nobody wants to be last out the door. That's forced selling. It's mechanical, not emotional. It's not about fear of the asset. It's about fear of the structure collapsing under you. Here's how it actually works. When you trade on margin, you're borrowing money to control a larger position than your cash alone could buy. Let's say you've got $10,000, but you control $50,000 worth of silver. That works great when prices go up. But when prices drop, the exchange gets nervous. They want to make sure you can cover potential losses, so they raise margin requirements. Now, instead of needing $10,000 to hold that position, you need $15,000. You've got two choices: post more cash or sell. Most people don't have extra cash sitting around, so they sell. And when enough people sell at the same time, it creates a cascade. Prices drop, which triggers more margin calls, which forces more selling, which pushes prices lower. It feeds on itself. Now, you might be thinking, okay, but doesn't someone step in and buy at these lower prices? Eventually, yes. But here's the thing. In a liquidation event, there's a lag. Buyers wait. They want to see where the bottom is. Sellers can't wait because they're being forced out by the exchange. So you get these air pockets where bids disappear. Volume spikes, but it's all one direction. And if you learn to spot that difference between fundamental selling and forced liquidation, you stop panicking and start observing. You see the candles. You see the volume. You recognize the pattern. And instead of getting swept up in the emotion, you're asking, what's the mechanism here? So what does that tell us? It tells us that violent moves aren't always about new information. Sometimes they're about old leverage finally unwinding. And the smarter you get at reading market structure, the less you'll confuse chaos with change. If this is making sense so far, drop a comment below and let me know where you're watching from, because I want to know who's paying attention to this stuff in real time. Now here's what's actually happening under the hood with silver. Silver had been pushed to extremes. Heavily leveraged, heavily traded, stretched thin across futures markets, options markets, exchange-traded products. When prices started slipping from that 120 level, exchanges raised margin requirements. That's the first domino. Traders who were leveraged 3-to-1 or 5-to-1 suddenly had to post more collateral. Many couldn't. Many sold. That selling pushed prices lower, from 110 to 100, then from 100 to 90. And each leg down triggered more margin calls, which forced more selling. That's the cascade I just explained. It's textbook. But here's what validated this wasn't just normal profit-taking. The drop was nearly vertical. We're talking about a $42 move in less than 2 full trading sessions. Liquidity disappeared. Bid-ask spreads widened to levels you only see during flash crashes or geopolitical shocks. And at the exact lows, around $78, reports started surfacing of major short positions being closed, while systems at key trading venues briefly went dark. I'm not saying that's a grand conspiracy. I'm saying that's a market under extreme stress, where normal price discovery breaks down temporarily. And here's the part that should make you pay very close attention. While paper silver was imploding, physical policy demand was quietly accelerating in the background. Nobody was talking about it during the crash because everyone was focused on the price action. But it was happening. And that divergence, that gap between paper liquidation and physical accumulation, that's what set up the snapback you just saw. Now let me show you what most people are completely missing while they're arguing about manipulation and conspiracy theories. While everyone was glued to the charts watching 12% intraday swings, the US rolled out a $12 billion critical minerals stockpile. $12 billion. That's not a press release. That's policy action. And they effectively said silver belongs in the same conversation as lithium, cobalt, rare earths, the stuff that goes into batteries, defense systems, energy infrastructure. They're not treating it like a shiny metal you make jewelry from. They're treating it like a strategic input. At the exact same time, and I mean within 72 hours, a 50-nation ministerial on critical minerals kicked off. 50 nations. That's not a coincidence. That's coordination. The EU floated a parallel partnership framework for securing supply chains. Australia reaffirmed commitments. Canada signaled alignment. This is happening across multiple continents simultaneously. So you had forced liquidation on one side, paper markets getting flushed, and you had structural demand signals on the other side, governments saying we need to secure this resource. When those two forces collide, you get exactly what you just saw. A flush, then a violent snapback. Fast, disorienting, educational if you're paying attention. Let me give you the third layer that confirms this wasn't random. Physical premiums, the amount you pay above spot price to actually get metal delivered, they barely moved during the crash. In a real fundamental breakdown, premiums collapse because nobody wants the physical product. But that's not what happened. Premiums held. In some cases, they widened slightly. That tells you the paper market was breaking, but the physical market was still functioning. It was still pricing in real demand. And when paper reconnects with physical, which it always does eventually, price has to adjust. That adjustment is what you saw in that 12% rip higher. So you've got margin liquidation as the primary driver. You've got policy demand as the secondary confirmation. And you've got physical market resilience as the convergence proof. All three together create the exact conditions for a washout, followed by a sharp recovery. This isn't speculation. This is pattern recognition. Now, before we go further, I want to give you some context because this is the exact same playbook markets have run before. Every single time a commodity crosses the line from tradable to strategic, it reprices. And it doesn't reprice smoothly. It reprices through volatility. Let me show you. In the 1970s, oil was just another commodity. It traded. It had cycles. Then came the Arab oil embargo. Then came the Iranian Revolution. Suddenly, oil wasn't just a trade. It was a national security issue. Governments started building strategic petroleum reserves. They started treating supply disruptions as geopolitical threats. And what happened to the price? It didn't move in a straight line. It whipsawed, it crashed, it spiked. But zoom out and the floor moved higher. The baseline price reset. Volatility increased, but so did the long-term average. By the early 80s, oil was permanently repriced relative to where it traded in the 60s. Same thing with gold after 2008. Before the financial crisis, central banks were net sellers of gold. They were dumping reserves, treating it like a relic. Then Lehman collapsed. Then sovereign debt exploded. Then trust in fiat currencies started cracking. And central banks flipped. They went from sellers to buyers. They started hoarding. And what happened to gold? It didn't moon overnight. It had massive corrections. It dropped 20% in weeks multiple times. But the floor kept rising. By 2011, gold had gone from under $300 in the late 90s to over $1,900. That's not a bubble. That's a repricing when the asset class shifts from discretionary to strategic. Look at lithium over the last 5 years. When electric vehicles were a niche market, lithium was cheap. Then every government on earth announced EV mandates. Then automakers committed trillions to battery production. Lithium didn't just go up. It exploded, then crashed, then exploded again. Why? Because the market was trying to figure out where strategic demand meets supply constraints. Same pattern. First comes disbelief, then comes policy involvement, then comes structural demand, then comes repricing through volatility. Every time you see this shift, the same rhythm plays out. And what's happening with silver right now? It's leaving the cyclical bucket and entering the security bucket. Solar panels need silver. Electronics need silver. Batteries need silver. Defense systems need silver. And now governments are publicly acknowledging that. They're not just letting the market figure it out. They're actively securing supply. That's the signal. And markets don't price that shift overnight. They price it through exactly the kind of chaos you just witnessed. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this bounce fail? Absolutely. Could we see another washout towards 70 or 75 if liquidity tightens again or if macro conditions deteriorate? Yes, that's possible. Could there be another wave of forced selling if interest rates spike or if margin requirements get raised again? Of course. And here's the thing about claims of manipulation. They're often overstated and they're rarely actionable. You can't trade outrage. You can't base a strategy on who you think is pulling strings behind the scenes. Maybe there are large players positioning aggressively. Maybe there are algorithmic systems that amplify moves. Maybe exchanges have conflicts of interest. I'm not saying those things don't exist. I'm saying they don't matter for your decision making because you can't control them and you can't predict them with any consistency. So instead of focusing on who did what and why they're evil, focus on what you can actually measure. Support levels. Where does price find buyers? Volume behavior. Is participation increasing or decreasing? Policy signals. Are governments following through or just talking? Physical premiums. Are they widening or contracting? Those are things you can track. Those are things you can use to make informed decisions. The rest is noise that'll drive you crazy if you let it. Could this whole move be nothing more than a technical squeeze that fades in 2 weeks? Maybe. Could silver chop sideways for months while everyone forgets about it? Sure. I'm not here to promise you a moon mission. I'm here to show you the structure so you can interpret what happens next based on evidence, not emotion. There are probably 3 types of people watching this right now. Let me speak to each of you directly, because your situation matters and the advice changes depending on where you're starting from. First, there's you if you're already positioned in silver and you're feeling the emotional whiplash from this move. Maybe you bought in the 90s and watched it rip to 120 and you didn't sell. Then you watched it crash to 78 and you felt sick. Now it's bounced back and you don't know what to do. I get it. That's brutal. Here's the advice. Zoom out. This isn't about 1 week. If you believe the structural thesis, if you believe policy demand is real and supply is constrained, then this volatility is the cost of being early. Reduce your leverage if you're using any. Seriously, cut it, because the next flush might take you out even if you're ultimately right. And respect the volatility. Don't assume it's over just because we bounced. Silver could easily test 95, fail, and drop back to 80. That's not bearish. That's just how repricing works. Your job is to stay solvent through the chop so you're still around when the structure resolves. Second, there's you if you missed this move and you're feeling frustrated. Maybe you were watching silver at 80 or 90 and you didn't pull the trigger. Now it's bounced and you feel like you're chasing. Don't chase. Seriously, markets always offer second chances. If silver is truly repricing as a strategic asset, there will be another consolidation, another pullback, another entry point. Watch how it behaves around 85 to 90. Does it hold that level? Does it base there? Or does it slice right through on volume? Watch how it reacts if it gets back near 95 to 100. Does it stall or does it break through with conviction? Let the structure confirm before you commit capital. Being late to one move is better than being early to a trap. Third, there's you if you're skeptical of this whole thing. Maybe you think silver's just a trade, not a transformation. Maybe you think the strategic narrative is overblown. Maybe you think this whole move was just technical noise and it'll fade. That's healthy. Skepticism is how you avoid getting caught in hype cycles. Your job is to watch how price behaves around those key levels I just mentioned. 85 to 90, 95 to 100. If those levels break decisively and hold, your skepticism should start shifting. If they fail and we're back at 75 in 3 weeks, your skepticism was justified. Either way, you're watching evidence, not narratives. Different starting points. Same principle. Let the market prove itself. Don't assume, don't predict, observe. And here's what I want you to answer in the comments, because I'm genuinely curious. Where are you in this? Are you positioned and holding? Are you waiting for a setup? Are you skeptical and watching? Let me know, because understanding where the community is at helps everyone think through their own position more clearly. So here's where I stand, and I'm going to be very direct with you. I'm not euphoric and I'm not bearish, I'm observant. I think this move was mechanical liquidation meeting structural demand. I think the paper market broke temporarily while the physical market stayed intact. I think policy signals are real, not theater, but I also think we're in the middle of repricing, not at the end. That means more volatility, not less. Let me tell you what I'm personally watching. First, I'm watching whether 85 to 90 holds as support over the next 2 to 4 weeks. If price keeps bouncing off that zone and making higher lows, that's bullish structure building. If it slices through on heavy volume and we're testing 80 or below, that's a different message. It's telling you the flush wasn't done. Second, I'm watching for a reclaim of the 95 to 100 zone, because that's where global parity matters. Above 100, you're back in territory where international buying accelerates and supply discipline tightens. Below 95, you're in no man's land where neither bulls nor bears have conviction. So watching how price behaves around that threshold tells you which side is gaining control. Third, I'm monitoring policy follow-through, not just announcements. It's easy for governments to say we're prioritizing critical minerals. It's harder to actually fund procurement, sign contracts, build stockpiles. If the US actually deploys that $12 billion and you start seeing inventory data shift, that's confirmation. If it's all talk and no action 6 months from now, that's a red flag. Policy rhetoric is cheap. Policy execution is what moves markets. Based on my analysis, this move was structural and technical converging, not random panic or pure speculation. The fundamental picture didn't break. It actually showed up. You had governments stepping in while paper markets were liquidating. That's the opposite of a fundamental breakdown. Now, could the fundamentals deteriorate from here? Sure. If global growth slows dramatically, if industrial demand craters, if solar installations collapse, then the thesis weakens. But right now, I'm not seeing that. I'm seeing demand signals accelerating while supply remains tight. If history rhymes, and it usually does, silver just told you it's no longer a side character in the commodities complex. It's moving to center stage alongside lithium, cobalt, rare earths, the materials that governments care about when they think about energy security and technological competition. And when that shift happens, when an asset goes from optional to essential in the eyes of policymakers, the move that follows is measured in multiples, not percentages. I'm not predicting that. I'm saying that's the pattern history shows us. Whether it plays out that way this time depends on follow-through, not hope. I'm not a financial advisor. This is not financial advice. Nothing I've said here is a recommendation to buy or sell anything. Do your own research. Verify everything I've told you. Check the sources. Look at the charts yourself. Read the policy documents. Don't take my word for anything. Your capital is your responsibility, not mine. If you made it this far, you're part of a very small group of people who are willing to think critically instead of react emotionally. That mentality, that willingness to dig deeper and question assumptions, that's what separates people who build wealth from people who chase headlines. Keep that edge. It'll serve you well, no matter what happens with silver or any other market. If this breakdown helped you see something you weren't seeing before, share this video with someone who needs to understand what just happened. Subscribe if you want more analysis like this when the next major move hits. And stay sharp out there, because the market's going to keep testing you. The question is whether you're paying attention or just reacting. I'll see you in the next one.